So welcome to all of you to Market Thursday. We are December the 17th. So that's exactly, as one of you was saying, that's the Christmas edition. Just as a full and quick disclaimer, those webinars are not investment advice. This is mainly for information and for you to get a process. So please do your own research before putting any position. Don't take everything here like this is something that you should do immediately. If you get questions as well, you can contact me on the website and sending me an email. Very quickly, as always, let's give me a bit of background of what I've been doing so far. So I started to work in 2000 in Paris as a cash equity trader, working for Pierre Charon Gestion, then for another fund manager, DTM, where we had roughly 50 million euros under management. In 2004, I arrived in London. I worked for Griffin Capital Management, which was a hedge fund. We were running both a long-only product and a long-short product. And where on the western part, we were running roughly 600 million euros. And the company overall was running between 2 to 3 billion euro. In 2009, I started to work as a prop trader here in London again for Infinity Capital Markets, where I had an absolute return mandate with no assets and region constraints. And that's something that I might do again in the near future. In 2014, I started to do mentoring program with another company where I mentored since 2014 more than 70 people from all across the world. I left that company in 2017 after disagreement with the management. And in 2018, I started my own mentoring program. And last year, I launched the 4x4 video series. So that was in October last year. And I recently launched a new website. So I hope you like it. I really want for the users to have the best experience possible learning from the 4x4. So today, what are we going to do? So as always, we're going to be starting with a situation across asset classes, looking at stocks, credit. So that means all asset classes. There won't be that much catalyst because this is the end of the year and we'll be closing many of our positions. We'll be covering what we discussed a couple of weeks ago, which was the Fed meeting and the ECB meeting last week and the Fed meeting yesterday. Tomorrow we get the Quadruple Witching, meaning there's going to be a lot of the possible volatility, a lot of volume in the market. Plus, for most of you, you know that Tesla is going into the S&P 500 at the close of tomorrow evening and coming on into Monday. So there is a lot of index rebalancing, not only in the US, but Tesla, because of its size. This is a talk and it's going to have possible repercussion probably in the last 10 to 15 minutes of the rebalancing, 10 minutes of the rebalancing of the S&P 500. Then finally, depending on the time that we have, I'll be happy to answer some questions if you have some. So as always, trying to do a bit of everything, a bit of price action, a bit of fundamental with macro analysis, a bit more trading action with quadruple witching and index rebalancing. So let's start with the asset class performances. So for the Bitcoin players, I never had so many tweets and people contacting me and telling me, you know, Greg, I told you so. So well done for all of the people that have been invested in Bitcoin. And again, for me, that's I really don't care. But you know, is it an asset? Is it a currency? The thing is, sometimes you trade what you want to trade. So looking at this performance year to date, Bitcoin is up 200%. It's even more today because it's up another 15%. So it's above the 200%. Looking at the other asset classes, so this is why we're going to switch into the next slide, which is not where the Bitcoin is not distorting that much the asset classes performances. So Nasdaq Composite, big winner, up 40% on the year. But we can see that across stock market, they have been doing pretty well, except like most of the time, Europe and the UK. Otherwise, you know, from emerging market to the US, we are between 10 to 40%. On the right-hand side, in purple, we have the dollar, and we can see that the dollar has been pretty weak over the year, between 5 to 10%. So for once and for all, if you've been looking at performance in dollar terms, actually you should, if you compare this performance against other currencies, this is a bit less strong. And you can argue that versus the rest of the world, if you are traveling as an American, which is not happening these days, your purchasing power is a bit down. On the right-hand side, we got the gold and WTI. We remember that WTI at one stage was down to negative and was down most of the time 40%. Now it's trading around the 47 level for the WTI. Gold is up 22%, but has been falling 10% from the recent all-time high. If we carry on looking at the week-to-date asset performance, so what I like to do to the 4x4, to the mentoring, is trying to find different time frames and understand what has been the price action over those different time frames. So you can do 1 day, you can do 1 week, you can do 3 months, you can do whatever. So here, S&P 500 is smaller, but the usual winner, which is the Nasdaq Composite, has been doing better at performing the market. The Russell has been on a clear, has been the clear winner, extremely strong. And overall, yes, the dollar is still weakening. So that's for the week-to-date picture. And again, on the right-hand side, if I do that, WTI up 5%. Why? Because it broke the 44 level, and the demand is now starting to pick up. Let's carry on with the year-to-date sector performances for the 11 sectors of the S&P. So energy is down 33%. That is the big losers. Financial has been recovering a bit, but it's still down 7%. And anything that is yields oriented has been struggling over the last 6 months or year to date. On the other hand, the cyclicals have been doing pretty well, and technology has been very strong. Consumer discretionary, this one is a bit distorted by Amazon, which is making a big chunk of it. On the week to date, again, that we just mentioned, IT has been outperforming. Industrials have been a bit struggling because there has been some slowdown of the US economy after the election and the COVID picking up again. I would like as well to discuss on the industry level. So here, this is the ETF Performances top 10 on the left-hand side here. And right-hand side, we get the bottom 10. We can see that solar, so that will be, if you're looking for a ticker, that would be TAN, has been extremely strong, making new highs after new highs. But we get interesting names that have been recovering. So again, this is the time frame over 3 months. That doesn't mean that year to date they have been performing so well. If you look at XLE, doing pretty well over 3 months, year to date, this is not the case. On the other hand of the spectrum, we get silver, gold, TLT, US dollar. So silver and gold, that is something that we mentioned before the election, saying that, in 2016, after the Trump election, gold suffered over the first 6 weeks, right after the election. And that is something that happened as well. That doesn't mean that the reasons are the same. But literally, gold has been suffering from the risk on, risk off. Now we are in pure risk on. And gold has not been very strong. Now the other asset classes performances, the bonds. So bonds have been flattish week to date and not moving that much. We are between 0.9% and 0.95% on the US Treasuries. There has been a bit of steepening of the yield curve. So for those of you who are not familiar with the yield curve, sorry. This is the 10 years versus the 2 years. And when the economy is expected to be better and some inflation to come, there is a steepening of the 10 and the 2. And when we think that we are going into the recession, there is the 10 years is getting closer to the 2 years. So now we are at 80 bips on the 10 versus the 2. Not moving that crazy. I think the move was done a month ago. The VIX, which stands for implied volatility for 30 months, for the next 30 days for the S&P, is still pretty high. On an historical level, we are 22% or plus, and there is still a dichotomy or quite a strong gap between implied volatility and realized volatility between 5 to 10%, which happens, 5–10% of the time. Market participants are still hedging themselves massively and are still using call options to play the upside. So there is distortion on the implied volatility. That is something to monitor. On the top winners and top losers, what has been quite interesting is the moves. Some moves have been quite insane. So there is a lot of SPACs that have been going up and down, mostly up and down. You get biotech names that have been moving. So on the single names, very, very strong moves. There are many trading opportunities. Having said that, we are talking big moves, and as well, this is not always easy to find the borrow to sell those stocks if you want to sell them, and you need to be aware of the liquidity issues. Next one is a bit of, I wanted to put a bit of macro analysis. So here, those are the US retail sales. US retail sales yesterday, they were not that great. I mean, this is not the end of the world, because year on year, the numbers look still pretty strong. But that might be some warning after clearly the elections and the COVID picking up after Thanksgiving in the US. And that tells us why the Fed is so keen on the politicians to push for fiscal stimulus. So US retail sales, as we can see, the core, which is ex-auto and gas, is down 0.8%. That's something, again, that you should be monitoring to see how the US consumer, which makes up 70% of the US GDP, is doing. Similarly, in terms of macro, we had yesterday some good numbers from Europe, once and for all. The PMIs, manufacturing and services, were better than expected. Still, they are showing some of them recession level, but it's not as feared as it was before. So that explains a bit as well why the euro has been doing better. But we need to keep in mind that I think it's the Netherlands and Germany are going into almost full lockdown. So that's going to have implications. So clearly, that is the picture. Europe doing a bit better than the worst case scenario, and US has been a bit, let's say, slowing. Let's look now at the price action. I was on the goal before the call. Let's look with the S&P. So the S&P, as we discussed a couple of weeks ago, is making new highs. So those new highs, again, there is a lot of liquidity in the system. There is no point in fighting. The trend is up. There is liquidity. The macro numbers are not that bad. So there is a lot, and the dollar is weakening. So if you do the same chart on the S&P 500 versus the euro dollar, you will see that there is massive correlation. So I invite you to watch the webinar from 2 weeks ago, when we look at this correlation between euro dollar, or the dollar, and the S&P. So that is why not only, but clearly that is helping the S&P going higher. What is interesting is now the Nasdaq Composite is making new highs. If you look at the long-term picture, you can see that the trend that we had since 2010. So that's a logarithmic chart. We are even higher than this. So there has been an acceleration in the growth of the Nasdaq. If we look at the Russell, which is for the small and mid caps, or mid caps mainly in the US, so that means mostly US sales. There has been a breakout recently, so this is on the weekly chart. Since the election, the Russell has been catching up. I strongly advise you to look at the correlation with the S&P, 5 years, 10 years, 20 years, to see who's lagging or not. I don't want to be spending too much time on the European charts. DAX is getting close to coming back to the level that we had before the sell-off in February of this year. I like to be watching the SOX Philadelphia semiconductor, because we know that there has been a big leader. It is not making new highs yet. Maybe it's a question of today or tomorrow. But again, if you want to start to identify divergence in the market, watch out for the leaders to stop. What has been interesting is the FANG, Facebook, Amazon, those names are not making new highs. So the market is making new highs with not necessarily the usual leaders. We still get some small leaders, but not as strong as before. Let's jump now into the currencies. So that's the euro dollar. I've been telling you for quite a long time that the chart was telling you this. Okay, so clearly that was calling for a weakening of the US dollar. So price action is here. I have to say that in terms of fundamental, I don't know what to think here. There is I think the COT positioning is not extreme but pretty high. Europe is not doing that great. So again, we discussed that a couple of weeks ago. Yes, the Fed has been much more active in increasing their balance sheet versus the ECB. And as we're going to be discussing soon, Powell yesterday said they're not going to do much, and actually they are fine of easing, having this level of easing. So that's the euro dollar. You can go versus any currency. The dollar is weakening everywhere. So that's the big picture for those of you who live in the UK, with the Brexit coming, not coming, maybe coming, not coming. So we broke this important level of 135.50. Next level is probably around the 140. So let's see how it goes. I think people are very underweight. The UK are very underweight sterling. So that's something to monitor. Versus the Turkish lira. Turkish lira, we are still consolidating. There is a bit less noise. The Bitcoin, new highs. So let's move on that. US 10 years, so 92, as I said, there is a long way to back to the 160%. If you look at the 10 versus the 2 that I mentioned before, this is, sorry for the chart, it's a bit dodgy on that platform, but we are making new highs. It's not, the move is not that strong, and I don't think that the Fed just want a large steepening too quickly, and they try as much as possible to have everything under control as long as they can. If we look at high yield, high yield is the same as the market, you know, slowly but surely the trend is higher. So there is a risk on everywhere. Emerging market, extremely strong, close to the 2018 level, breaking out. Keep in mind that emerging market 60% roughly is China. So as long as China is doing fine, and China is doing very well versus the rest of the world, you have other part that we discussed in the past, that Brazil is doing extremely well in terms of PMI. So those are the regions to check. WTI, as I said, broke the 44. Now the next level is probably, you know, the 52, 50. That is quick. There are a lot of expectation coming in the next 3 to 6 months that demand will pick up. So we are, for the industry, in a level that the industry likes. The oil majors like to have oil above 40, 45, where they break even, they start to be making money. So everyone's is starting to be happy. The downside that you're going to have is the OPEC countries will probably, some of them will probably start to produce a bit more. So more production could come into the market. The gold, I know that there are many of you that are looking at the gold. So the 1850 was a big level. It's still fighting around this level. Not a clear picture. There is, I mean, I don't know what to think about this one. I don't have a review, to be honest. Copper is making new highs. Okay, and then we get many stocks. I strongly advise you again to look at these 11 sectors, and for instance, looking at the 11 sectors of the S&P and looking at how they do versus the S&P. I was interested recently utilities versus the S&P, so making new lows. XLU have been struggling for the reason that we know that when yields are going higher, this is not good for XLU. XLRE, that's the same. But I strongly advise you to check those ones. So what about we go back into this PowerPoint? All good? You can still hear me? Yes? A thumbs up? Can someone tell me? Yeah, you can see everything. All good. Thank you, Paul. At least Paul is quick to react. Next one, as we discussed a couple of weeks ago, the Fed. So yesterday we had the Fed meeting. Pretty boring, to be honest. So my conclusion, and not only my conclusion, reading some people that are smarter than I am. So there is no changes to the program. They are not keen on doing something too quickly. So no need to do more with monetary policy. And what the Fed has been saying, what the ECB has been saying, and that was the same was when Draghi was running the show in Europe, they were calling for fiscal stimulus for really the politicians to help. But what was interesting is actually they revised the economic expectations based on the vaccines to go up in the next 3 to 6 months. So probably from Q2 2021, the US economy will start to do much better than what they were expecting. So if you think about it, on one hand, they said, we think that the economy is going to do better. And on the other hand, they say, we are not changing anything. So that means more easing. So that's similar as doing more easing. Again, they kind of reiterate their target of low unemployment and inflation for the Fed to hike. You remember in August, they kind of say, despite having a 2% PCE target, we are keen on getting more than 2% inflation because inflation was too low for too long. So if it runs to 3% to 4%, we will let it go. That is a tough one because if and when the inflation is going to go above 2%, that's going to make the conversation and the talks of the Fed much harder to read. So now there is a bit of inflation in the system. Powell said yesterday that it was just like for a short-term period. But clearly, as we're going to be saying now, if we look at the Eurodollar futures, which are looking at what is the market expecting for the Fed moves in the next few years, market is expected nothing to come. So that is a trade that is not obvious to do, but if you think that in the next 2 to 3, 4 years, there is inflation coming in the system. So if you are a Bitcoin player, if you are a gold player, I think there is a beautiful trade, which is, buying some put Eurodollar future. Then you decide which strike, with maturity. Is it gonna happen in 2021, 2022, 2023? I don't know, I'm not sure. But what you have is the risk reward is no one is expecting anything to happen. So you can be buying the March 2023 where nothing is expected and buying some put 99, 15, 99, 25, you choose. And the payout is going to be quite insane. So again, this is not investment advice. This is just something that I'm clearly monitoring. Those are the payout when the volatility is pretty low. Implied volatility is low because other asset classes implied volatility is very high, and expectations are all the same way. You're gonna have a nice payout. This is the opposite payout that you had at the start of this year when suddenly the Fed fund rates went from 98.50 to 99.50. So that's the same. So have a look at it. if you are interested, I think those are probably a nice payout. But just looking at this chart, again, the Fed, market participants are expected the Fed to do nothing for the next couple of years. And this is why as well the dollar is running, so it's weakening, because we expect the Fed to carry on with that story at least for the next 2 years. Fed balance sheet, and on the left-hand side, ECB on the right-hand side. You know this picture. Sorry if I'm a bit boring and putting it again and again, but I think that is so important to understand the risk on, risk off. As long as the central banks are providing liquidity in the system, that means you have a re-rating of the market. So if you look at the EPS of the S&P 500, which is at 165, 170 for next year, for 2021, you are 25 times something, and we used to have 16, 17, 18 times. So you get cheaper access to money. This is easier, and that has implication across asset classes. So for the full record, it took me some time to process those ideas sometime, but that is what is happening. You have a lot of liquidity. You get the SPACs, you get IPOs, you get private equity that don't know what to do with their money, and that is fueling a lot of risk on. And Bitcoin is another way of looking at this risk on. ECB, I think the ECB meeting, not because I'm European, was a bit more interesting. I think they did more than the Fed, probably because the Fed did a lot before. So central banks, ECB, no rate cut. The PEPP, which stands for the Pandemic Emerging Purchase Program, was increased by 500 billion. The APP stands the same. What was interesting is their TLTRO, which is their cheap financing for banks. So there are new ones coming. I think what was really interesting as well is there were some questions with Lagarde on the euro level. You can start to smell that the ECB is not really that happy about the euro dollar. Now we are at 122.15. That helps, obviously, the US. That is something that the Trump administration has been pushing. That is, any administration has been pushing across the world to weaken its currency. That is really happening here. You don't want the euro, if you are running the ECB, to be strong, to be too strong, because it's going to have implication for inflation as well. So that, I think this is something to monitor in the next 2 to 3 months, what the ECB different governors are going to say about the euro dollar. Why? Again, because the dollar is really driving a lot of assets these days. So tomorrow, what we're going to have, the Quadruple Witching Day. So I used those slides 3 months ago, not only because I'm lazy, but because, you know, it works perfectly fine. So every third Friday of the months of March, June, September, and December, we have what we call the quadruple expiry, which we have the expiries of stock index futures, options, stock options, single stock futures. So in reality, this is a triple witching. Forget about the quadruple witching, but it's good if you're reading the papers. And what you're going to have tomorrow is the big volume day. So that means it's going to distort a lot of our charts. If we look at the volumes, tomorrow is going to be an absolute insane day. Even more true as we have a lot of open positions through options, so open interest, and we get rebalancing. So again, today, many positions. So what I suggest you to do, this is something that we cover when we do the mentoring. We try as much as possible each time we put a position on an index, on an ETF, on a stock, to look at where are the open interest, because that's going to tell us quite a lot where the market could be heading. Historically, as we had this week, coming into the expiry, the OPEX, the S&P is slowly but surely going up and grinding up. After this expiry, what you can have is a rebalancing of some of the portfolio. If you think about the timing now, most traders will close their position. If you are running a hedge fund, if you are running a portfolio, you might reduce your exposure, but you're still going to have exposure over the 31st of December. But still, normally the volatility is coming down from tomorrow until the start of January, because market participants are just going away. What you can have for this year, which could be interesting, is Biden, as we know, Biden administration might increase taxes from next year. So what you could have is some market participants will be tempted to sell some of their positions to capture and pay less taxes from next year. We'll see. That is something to watch from after the expiry for the next 10 days. So when you go into the quadruple witching day, what you can do is either you close your position, you roll your position, or you offset the position. So that's from tomorrow, and that's true for any markets. So S&P options are maturing on the third Friday before, and the settlement price is the opening prices of each of the index stocks. So that will be on the open. But for the SPY options, they stop trading at the close of business on expiration Friday. So even if for some of you it sounds like just noise, actually could make a big difference between the moment, which will be 2:30 UK time for us, or 9 UK time, at the close. There might be a big changes, and that could have a lot of implication if you are holding a position. That is even more true with Tesla tomorrow, where people will be running many positions. What you do when you're actively trading, you'll be trying as much as possible to check when are those different markets closing or expiring, sorry. So here, this is an example. The Swiss market is closing at the open at 8 a.m. UK time. UK between 10:10 and 10:15. In Europe, the Euro stocks from 10:50 a.m. UK to 11 a.m. So I can bet you that from 10:50 to 11 a.m. tomorrow, the Euro stocks 50 is going to be moving quite a lot, 1% at least. And you got names that are going to be moving massively. If you are trading the DAX, the German market, there is the print at 12:05. And you could have from time to time very big moves on some names on that close. That is something that over the years you never know, but I've been making good money over the years. And trust me, any traders tomorrow is normally extremely busy on the close, open 10:50. So that's not one of these days where you're running away from the market. So that's a special situation. There's another special situation that comes most of the time with this third Friday of the month of December, which is the index rebalancing. So here I took the example of the stock 600, where index rebalancing means either you're going to have some stocks where their weighting is going to be higher or lower, or you're going to have some additions and deletions in these indexes. So if we look at the stock 600, we got roughly 8 names going in and 8 names going out. And the way you do this special situation is first looking at what are the potential names that could enter the index. Then when the announcement is made, and how it's going to be, the stock is going to be behaving between the announcement and the effective moment it is going into the index, and then afterwards. So again, as a trader, as a portfolio manager, if you have position, you need to be fully aware of this, because you can have 3-5% move tomorrow, for instance, on the close for the names that we have here. So if we take the example of Flutter, it is supposed, it's not supposed, it's going to be joining the Stocks 50 tomorrow. As Unilever, having a dual headquarter, is moving out of the Stocks 15. So Flutter used to be the Paddy Power powder. So this is the chart. I think the next chart is more interesting. You can see the outperformance of Flutter since it joined. It was announced that they will be joining the Stocks 50. So in orange we got Flutter. In purple we got FTSE, the FTSE, and in green the Unilever. So you can see that those are the kind of trades. And again, for me, it's kind of easy to say, look, guys, this is what you should be doing. Don't get me wrong. It's not because the chart is telling us so that it was an obvious trade. Okay, but if you do rebalancing, those are the trades that you try to be putting, which is you be buying the Flutter as active and passive fund managers will have to increase their positioning, their weighting in Flutter. And on the other hand, some market participants will have to offload Unilever. So why I'm talking about Flutter and index rebalancing is because, is because of Tesla. So tomorrow, what happens? Tesla at the close is going into the S&P 500. And because of the size of Tesla, which is more than 500 billion, there were talks that they could do the entering in 2 phases. And actually, it's going to be a one go. And that has implication as special situation and active and passive funds which have to buy. If you are passive fund, if you are an ETF, what you do, you don't care about the price. You just need to be buying Tesla when you have to. So if you look at their notice, they need to buy Tesla at the close of Friday. Having said that, because the size is so big, they have agreement with some investment banks, and they agree on the price of the close, meaning that they have an incentive of pushing the price higher. Guess what? Because if they buy at 630 and it prints at 660, they are making money. And as well, you know that there's going to be a lot of open positions. So we already have a lot of open position with call options because there's a frenzy for call options in Tesla, because you know everyone loves Tesla like Bitcoin. But not only, it's as well there are structured products based on this inclusion into the S&P. So if you have nothing to do tomorrow during the US close, I strongly advise you to put 20 or 30 minutes of your time instead of watching Netflix, do something else, watch the S&P, look Tesla. The idea normally will be Tesla going up and the other 499 stocks to go down. But as always in 2020 and with the market, the plan is not really always happening. So since the announcement, so let me give you, since the announcement, the stock, so that's the gap here, that's the announcement, and since then, the stock is up $200 roughly. So we are up 50% in a month, so that's quite a huge performance. I know what you're going to tell me. You're going to tell me, so Tesla now, it's 600 billion market cap, 1.5%. And I think this chart is interesting because you can see that really this is the first time that such a big company is entering the S&P 500. So if we think about the size of passive investment these days, and the size of options and derivatives, you can be sure that you know there is a lot of happening tomorrow. So Tesla is making the headlines. I think what is a bit easy to sell, harder to do. So looking at the chart that we've seen before, so the stock went from $410 to between the moment of the announcement and now at 635 or 650. Obviously, you can say, "What about I sell it?" Because you know this is the trade. And one of the ways of doing it is saying, "What about I do a put spread?" And with options for the last Tesla, for the last 5 years, every single day you're gonna have this tweet, you're gonna have this guy on Facebook, this guy on YouTube telling you, you know, it's easy to trade, good with options. And here I think this is pretty misleading. Why? Because of the move that we have on Tesla, the implied volatility is just very high. So if we look at Tesla here, Before the announcement, the stock was trading at $410, as I said. The next earnings are on the 27th of January 2021. So what about we do a put spread? Okay, and I say, I want to do a put spread because I think that the stock, which is trading at 630, is going to go back to 410. Okay, but me as a trader, what I'm interested is the risk reward. How much money can I make? How much money can I lose? So I checked yesterday morning, what about the put 630 February, which is covering the 27th of January earnings. So it cost me $86. Okay, so I do have like a debit of $86. And I'm going to be buying, so the put 630, and I'm going to selling the 410 put for $10. So my overall cost is roughly $75. Okay, here we got an issue, which is the implied volatility is at 81%. So if my cost is $75, how much money can I be making? First, my break-even is at 554. Why? Because I take the last minus the cost, and that gives me my break-even. What is my best case scenario? My best case scenario is for the stock at the expiry to be at 410, where I'll be making $220, 630 minus 410 on the options, minus the initial cost. Okay, so I'll be making $144. So if I can lose $75 and I can be making $144, my risk reward is 1.9 to 1. So not even 2 to 1. So if I look at this risk reward, first thing first, it's not that great, 2 to 1. And I need to put, sorry for my English, shitloads of capital for such a trade. So be extremely careful of saying, you know, oh, I'm going to be trading Tesla, it's fine. Now I'm going to be buying a put or a put spread because it's going to be moving big time. Literally, for this stock, for Tesla to be making good money on the put spread, you need a crazy, crazy move. And if you think about the risk reward, if you think the end of the world is going to come for Tesla, why you are limiting by selling the 410 just to save $10? Okay, you're better off, you know, buying this put or buying out of the money put rather than doing a put spread. So again, do your work, and this is why I said a couple of times today, check, do your homework, because what you're going to read sometimes is very misleading. I know that every single week people come to me and say, look, Greg, you know, what you don't do only mentoring on options. It's all about options. Trust me, options is part of the game. It's going to help you. It's going to be well for hedging. It's going to be well for direction. But doing options only, I really don't believe in it. Quickly, 2021. I wish and I hope that I'm going to be doing a webinar in January on 2021, the same as 2020. Some of the points that I'm already looking at, like any of us. So COVID-19, obviously the vaccine implementation, so that's for the global market. More interestingly, in terms of short-term time frame, on the 5th of January, we got the Georgia runoff elections. And that means if Democrat wins, Biden is going to have a majority of both the House and the Senate. So first reaction might be, it's great because we're going to have a huge fiscal stimulus. So you get a hoo-ha-ha, which is typical in January with a lot of money coming into the market. In the long run, and as I said many, many times over the last 6 months, is I don't think this is necessarily a big positive to have the Democrats full power. What you want is have a balance between Democrats and Republicans. So that means, you know, looking at options again, you might be looking at VIX implied volatility, S&P that are maturing, expiring around the 5th of January because there might be some trades. Something else that I'm watching over the last 4 months is the SPACs. Why? Because there has been many, many crazy stories, and I think for a trader, you need to go where there is a lot of things happening. Paul, what is your overall view of SPACs? What is the pros and cons? I think, Paul, that is a good question. I heard from very good sources that some traders killed it trading SPACs. They absolutely killed it. So you get, I think there's an arbitrage to do. I'm not sure what is the trade. I think the arbitrage is with the warrant, with the options. I'm still, so what about the SPACs? It's really telling you how there is a lot of liquidity into the system, because you, first thing first, you are giving away a lot of money to those managers. SPACs are mainly trusting about the quality of the management and the story. So it's kind of a private equity on steroids. But as a trader, you know, be agnostic and just trade them if you want to. I think there are some good websites out there that are giving you the calendar, where to trade, when they are coming. Again, I don't have I trade the momentum. I think, Paul, you're right. It's about trading the momentum. You know, we are trading SPACs these days. In 6 months' time, is going to be another one. But you need to put the SPACs into the trading pocket. And you don't necessarily have fundamentals. I think what is hard for me is you don't have, even if I'm not a big analyst and fundamental guy, because my background is trading, I like to have a bit of content on understanding what is the business. So if you tell me I'm going to be buying this concept, I can't put any valuation on it. So that's the struggle. But again, this is where the money is going. The new money, I think I checked recently, there has been between 30 and 50 billion raised over the last couple of months. So do your setup. I have my setup on Icon Metastock. I like it. So that's for the SPACs. Another one that I like is the idea of infrastructure. That's something that I pushed over the summer. EURUSD is doing pretty well. The chart is doing nicely now. I saw that Biden yesterday went for, can't remember his name, for the infrastructure slash traveling slash in the US. So there's a lot of needs of infrastructure in the US. I think this is still a trade. If you're lazy, you do the ETF. If you're less lazy, you go with single names. Then we get the ESG. ESG, on one hand, you can argue it's good for the environment, for sure. On the other hand, you can argue that this is a lot of bullshit for the industry selling all their products. Bottom line is the BlackRock, many guys are pushing for ESG, meaning that there is a lot of money, a lot of flows that are going into ESG. So monitor the flows, ETF, single names. This is the space that in the next couple of years and more is going to be very hot. And that gives you some leaders. And as long as there is this talk, the leaders are going to win. And it really doesn't matter what is your view. Try to put aside your view if you want to be making money as a trader. Then we get, as I said, I think that really, really important, because that's been driving the market for the last 3 months, is the US dollar slash Fed slash, the second derivative, which is commodities, which are rates, which are emerging market, and the euro dollar. So there are many trades to do here. Again, easy for me to say, much harder to do. So I'm not pretending that, you should have 20 trades that are ready. What I'm telling you is looking at those second derivatives. If you look at emerging markets, don't only do a filtering on EM, do your filtering on countries like Brazil, South Korea. And if you look at commodities, you can do the second derivatives of commodities as well. So that would be for 2021. If you're keen on me of doing a webinar, let me know. I need a bit of push, because next year I'm going to be more busy, because normally I'm taking a book again. So the story is moving a bit. Education, 4x4 video series. So that's a product that I built last year. I spent 6 months on it. I launched it in October 2019. So that's a very comprehensive online video course. I use my experience as a past educator for another company where people were struggling with some concept and some mistakes. And I use my experience for the last 20 years as a trader and a portfolio manager. So the idea is to try to generate ideas consistently through top-down, bottom-up, special situation, and active trading. You'll have 40 videos, around 30 hours of footage, plus 50 Excel spreadsheets that are updated as much as possible. I think the new website is really good. The user experience is much, much better. And if I'm not too lazy, I tend to do soon a certificate for people that are interested to have a diploma. With the 4x4 or not with the 4x4, I do the mentoring program. Here I do have like a capacity issue because I have some people that came to me recently. If you have interest, let me know quickly. I don't want to have too many because otherwise I think I'm going to be a bad mentor. So I want to limit my capacity. So if you've done the 4x4 video series, from my experience and talking with my mentees, it's much, much better than using other education. That is now my strongest conviction. This is 12 weekly one-on-one session on Skype, where similar to the 4x4, we're going to be building your infrastructure, and I'm going to help you the first session building your infrastructure, doing quantitative analysis, qualitative analysis, price action, technical analysis, a lot of risk management. We're going to do a lot of options as well, not because there's been the talks of the last few months, but because this is my conviction that options can work well. I know that sometimes we might be struggling with options because, you know, intellectually we are struggling with, you know, the Greeks. And my process, the way I've been doing my investment process is, as long as you understand, as long as you're in charge, you do. When you don't understand something, you just stop. So with options, you know, I try to explain to you with the Tesla example. You know, it's easy to say, I want to be short Tesla and I'm going to be putting some put spread in the next 2 months. Then you look at the risk reward, you need to put 50 times 100, which is $5,000, to be making 2 times this money. But with the time decay, you can be losing quickly. So be careful on this. So mentoring program, it works. Come to me if you're interested. With the 4x4, because this is Christmas, until this end of this month, we offer 25%. So you can use holiday 25 going into the website. If you have issues with the payment or if you have questions, I'm more than happy to answer your questions. If you want to do a Skype call on the 4x4, on the mentoring, I think it is worth having a call together. If there are synergies, if I can help you, and if I can't help you, then I'll be still happy to talk to you and sharing with you what you have been doing. So offer until the end of this month. If you like what I do, I know that's the way it works apparently in those new medias. Retweet, say that you like, put a like under the YouTube video, do those kind of things that help massively, and that helps for motivation. As I said, from next year, I'm going to try as much as possible to do those webinars because I enjoy doing it. Try to put some content, keeping in mind that I have still mentees and I put full dedication to that. And I'm targeting as well to have a professional book. So that is for you to know. Thank you for your support all year long. So let me try now to answer some of the questions. So Gary O'Brien, sorry if I say the name. What's your opinion on the CFA? CFA, so I started in 2008, level 1. So I was moving from hedge fund to prop trading. So I had the level 1, and then I had to move to another job because at that time I was working for Madoff. And I lost my job and I was in the middle of doing level 2, and I started at Infinity. And started at Infinity, I had to focus 100% on the trading. That means CFA went through the window. And for me, then I decided, you know, I'm a trader. What matters to me is to be making money. And what matters to my boss is to be making money. So to answer your question, Gary, I think the CFA, you have 50,000 people that are doing it every day. So if you want to work in the industry, that is a kind of, you have to do it, okay? If you want to work in prop trading, nobody cares about the CFA. If you want to work for a hedge fund, they do care. Why they do care? Because when you do the presentation, when you try to raise money, and if you say it's on Gary or on Gregoire Dupont, that's it, that's not posh enough. So you need to kind of pretend that you've done the CFA. If you think about the CFA, it's about 300 hours times 3, sweating and just not learning like crazy, but just spending time, you know, reading books. And so it depends, Gary, send me an email, depending, and explain to me what you want to achieve. And depending on what you want to do, CFA might, I'm not a big fan of CFA. I don't like the concept of doing the same thing as anyone else, because I don't think that you do something that is different from the crowd. And what is important is to do something. The competition is going to be huge to find a job, either in hedge fund, prop trading. If you want to go for prop trading, what matters is, you know, is having an investment process and be making money. The rest is a bit of no point. Tay, sorry for the presentation. If you're interested in the mentoring program, you send me an email. We can have a Skype call. That's the way I do. Sergio, my friend Sergio, South Africa. I hope you're good. I know it's not relevant, but which currency do you measure your net worth? This is why I said, you know, if you look at the US dollar, people are put down 5 to 10% in US dollar terms. As an investor, most of the time, and as 90% of the transactions in the world are made in US dollar, this is clean dollar, okay? So then you need to make a decision as an investor, how much long you're going to be spending money and where do you need the money, okay? If you are in euro, if you're in the Eurozone, what you need, if the next 50 years you're going to be in the Eurozone, you need euro, okay? If you are in emerging market, you know, you need to do probably a bit of quite a bit of US dollar. So it really depends what are your needs in terms of cash outflow, and not only now, but in the next 50 years. If I take your example, Sergio, you live in South Africa, you've been traveling in France, you've been traveling in other parts in Europe. So that means if you tell me the next 6 months, I'm going to be putting windmills in Norway, then you need to have some Norwegian kroner, okay? John, when you say Madoff, was this Bernie Madoff? Yes, it was. So if you look on the website, there is a blog, I think on the 12th of December or something. So I used to work for 6 months for Bernie Madoff. So yes, I should probably do another blogs and explaining to people what happened. I'm smiling now, but trust me, at that time I was not smiling. Whatever, it was more painful than anything else. So yes, but there are some interesting stories about Bernie Madoff and what happened there. Anything else? If there is anything else, so Happy New Year to all of you. Thank you for joining. Thank you for the support. It has been really great. I want to carry on like this. So all the best to you. Merry Christmas, Happy New Year, and come to me if you get questions, issues, and hopefully I'm going to try to do as much as I've done this year. Thank you. Merry Christmas. Happy New Year. Bye bye.